Hello and welcome everybody to Tridge's webinar called Currency Risks and Strategies in the Agricultural Trade Amid Uncertainty. So this is the second part of a two-part webinar about currency fluctuations. So the first webinar is called How Currency Volatility Impacts the Agricultural Industry. And that can be found on Tridge's platform. That can also be found on some different media platforms, for example, YouTube. We did that one a couple of months ago, so also check that one out to link to this webinar. Now, some of you might be joining us for the first time today, so I'm just going to briefly introduce Tridge. So we're an intelligence and sourcing provider. So we deliver like valid information, timely analysis of the agricultural industry, because we have a lot of experts on the ground and they're able to give us like the insight of the market and what's happening. So our intelligence includes daily analysis on prices, regulation, production, seasonality, and even more. And we're putting this content out there to help our clients, to help them make the right decisions and to use as intelligence in their business. So you can always visit our website for some more information. It's www.tridge.com. So there are just two technical points that we're going to cover. So if we go to the next slide, it will show you that the best layout or the optimal layout we can use for this webinar would be the side-by-side view, which we recommend. So you can just click on that, and that way you can see the presentation and you can also see the presenter at the same time. And then there are also some captions available if some of you would prefer that. The captions are available in English, Spanish, French, and German. So if you just click on that little speech bubble icon, and then you can choose the show captions option. That will give you these different options. Then the next technical point would be the certificate of attendance. So if some of you might require a certificate of attendance, so we ask that you complete the survey, and then after you've completed the survey, you can fill in your data and you can get the certificate of attendance. Now, the link to the survey will be shared close to the end of the webinar when we're doing the Q&A session. And this survey will just help us, improve our webinars in the future and give you an optimal experience. So with that, the two technical points done, let's move on to the agenda. So in today's agenda, there's going to be three different parts that are going to be covered in the presentation. So they will be, the first one is going to be the risks in cross-border trading with currency fluctuations. And then most importantly, the strategies we can use to kind of hedge against these risks. And then also some specific case studies. And then part 4 will be a panel discussion between Tridge's panelists, which will be more the practical implications of these hedging strategies. Next, just to introduce the people involved in this webinar. So I'm your host. My name is Theo. I'm in the contents creation division of Tridge, which basically means the content that we put out on our platform and we share with our clients go through us. The three panelists we have today are Ahmad, Rene, and Theo. Now, I'm going to ask them to introduce themselves when we get to the panel discussion. So just a quick background, all of them are representatives of Tridge in different countries, and they are in countries where currency fluctuations is playing a significant role at the moment. So that's why they'll be joining us today. So also looking forward to that. Then our presenter today is going to be Rene. So Rene is going to tell us more about quite a complicated topic, and then just how we can kind of hedge ourselves against these currency risks. So I'm going to ask Rene to just give a brief introduction of yourself and then take it from here.
Perfect. Thank you, Theo. My name is Rene Salinas. I'm a global market analyst here at Tridge. I just study what happens with the agri markets, the agri commodity markets, specializing in meat and seafood. I'm also an economist so hopefully this comes in handy for this presentation. I thank you everyone for being here, and I'm very happy to be here with you. So next up, I'm going to be speaking about some ways buyers and sellers can hedge for volatility risk. As Theo said, this is like the second part of the currency webinar. First, we explored how our exchange rates determine how they affect agri trade, and now we're going to see more how they what are the strategies to actually hedge for those risks of currency volatility. But first, I want to speak about some points I touched in the previous webinar. So first here, how are exchange rates determined? So there's a lot of variables in play that can influence exchange rate fluctuations. Some of them are differences among countries between interest rates, inflation rates, income levels, trade balances, and expectations of all of these variables. So as we have seen throughout the year, as the interest rates differences between countries widens, we may expect the currency of that country with the interest rate hikes to strengthen against the other one. The changes in exchange rates caused by this variable can be seen pretty quickly, as we have seen with the US dollar. Differences in inflation rates also impact exchange rates, but they typically happen over the long term. If one country experiences less inflation than the other one, we might expect a currency with a lower inflation to strengthen against the other one. Changes in income level through changes in technology, efficiency, etc., can also influence the exchange rates. So the country that gets more income actually has more purchasing power, so he can purchase more of the foreign currency, so the actual foreign currency is going to appreciate more. And we can also see trade balances, which are the differences between what you export and what you import. If you import more than you export, then we talk about a trade deficit. And if you have a trade deficit, that means that demand for the foreign currency is growing faster than the demand for your own currency. So that means your currency will depreciate if you're importing more than you're exporting. And finally, expectations of all of these variables. So if there's any changes in expectations of interest rates, inflation, income, or trade balances, this can have an impact on the actual price of your currency right now. Please go ahead, Tim. Okay, so why are exchange rates important for agri-commodity buyers and sellers? Basically because they can impact our bottom line. Exchange rate fluctuations can impact the purchasing power of buyers and the willingness of sellers. This can change the real price of any product and affect production planning and trade flows. Of course, this applies to both agri-products and the inputs to grow them or harvest them. The effects of volatility change if the prices of my product are in US dollars or in the local currency. The effects are different if the price is in dollars or if the price is in the local currency. Okay, so now let's talk about a particular type of risk exposure in agri-trade, which is transaction exposure. When I'm talking about transaction exposure, this involves a contract to buy or sell commodities in a foreign currency in the short term. There's other type of exposure. It can be economic exposure, translation exposure, but we're now going to focus on transaction exposure, which is just a contract to buy or sell products in the short term. Okay. So that transaction can be a payable, which means a buyer or importer, in this case, we're talking about cross-border trade, would need to get a hold of that foreign currency to pay for that product. Okay, so a buyer would need the foreign currency to buy for the product cross-border. The transaction can also be a receivable, which means a seller or an exporter would get the foreign currency as payment, and therefore would need to convert it to its local currency. Okay, assuming most of his transactions, such as to pay salaries, going to the movies, etc., are done with the local currency. Please go ahead, Theo. Okay. So let's look at the payables part first. Okay, so how can a buyer map his exposure to currency volatility, assuming He's a buyer. So now I'm talking about a payable, okay? So let's assume our buyer has to pay in a foreign currency. So he would need to convert his local currency, which is the currency in which he earns his money, to the foreign currency in order to make such payment, okay? Let's look at this particular example. A Japanese buyer agreed with a Vietnamese shrimp supplier to buy 50 tons of shrimp at a price of 200,000 per kilogram of Vietnamese dong, okay? Our buyer can map what he actually needs to pay in Japanese yen depending on exchange rate fluctuation. So if the yen stands at 166 Vietnamese dong per yen, okay, you can see here the first column, he will have to pay 60 million yen. And of course, he doesn't want that. So he's yearning for the Japanese yen to appreciate against the Vietnamese dong. If the Japanese yen strengthens to 186 dong per yen, and that way he would have to pay just 54 million yen, which is a big difference. The 54 million yen, you can see it at the last column of the graph. So this is the whole gap of the whole range of scenarios he has depending on how the currency movements are. Please go ahead, Theo. Okay, now let's see the seller side, the receivables. Let's say the transaction is set in US dollars. And while having dollars is nice, of course, the seller would need to convert those dollars to his local currency eventually, so he can, as I said, he can pay salaries, go to the movies, or anything involving in the local currency. So the seller wants to maximize the amount of local currency he or she will get from the dollars he or she is going to receive. Okay, let's look at this particular example. So a Brazilian meat supplier agrees to sell 30 tons of beef at a price of $6 per kilogram. Now, remember, he will eventually need to convert that amount received in dollars to Brazilian real. So our buyer will map what he's going to receive in Brazilian reals depending on the movement of the exchange rate. If the Brazilian real is at 5 real per dollar, the seller will get 0.91 million real, which is the first column here. But if the Brazilian real depreciates to 5.63 real per dollar, he will be getting 1.01 million real, which is, of course, better for him. Okay, so you can see here the range of scenarios he has depending on the exchange rate. Please go ahead, Theo. Now that we mapped the different scenarios, let's see some strategies that the buyers and sellers can implement in order to hedge for potential losses in case of unfavorable exchange rate movements. Okay, let's see this first case, which is a buyer, so a payable transaction with avocados in Mexico. Okay, so a US buyer secured a deal with a US retailer, so US with US first, to sell 100,000 9 kilograms avocado boxes at a price of 25 per box. Okay, so my buyer here is going to sell to a retailer, but he needs to get the avocado from somewhere, right? At $25 per box. So this buyer then goes to Mexico and contacts his Jalisco exporter and agrees to acquire the 100,000 boxes at a price of 380 pesos per box in 3 months. Okay, so the price to get the avocados is set in pesos. Okay, and it's going to be paid in 3 months. So, of course, he wants to minimize the amount of dollars he would have to pay for that transaction and thus maximize his margin with his sale to the retailer. Okay, how much will he pay in dollars? Well, it will depend on the exchange rate, of course. So he's submitting to currency risk. If he has the money now, he could pay at a spot rate of 19.50 pesos per dollar and pay a total of $1.95 million. But if the peso were to appreciate to 17 pesos per dollar, he will have to pay a total of $2.2 million, which of course is a big difference of over 200 grand. Okay, he wants to avoid that potential loss. So what can the buyer do? He, of course, could be willing to pass the extra charge in case the peso strengthens to the retailer, but he already agreed to sell the boxes at $25. I mean, sometimes you can pass the charge to the final buyer, but sometimes if you agree at a price, well, you can do that, okay? So he wants to hedge the US dollar depreciation risk somehow, okay? Here's some of the strategies he can do to hedge such risk. First, he could purchase a forward or futures contract and know beforehand how much he will have to pay in dollars. That's what that's the point of the forward. So he doesn't expose himself to currency volatility. He can also do a money market hedge and also know beforehand how much he would have to pay in dollars. I will explain what this is in a minute. Or he could acquire a call option to buy pesos at a fixed exchange rate when the time comes. Remember, he wants to acquire pesos, or he needs pesos to actually make the payment to the Jalisco seller. Okay, so let's review the forward first. So a forward is basically a contract between a company and a financial institution to buy or sell a particular currency at a determined exchange rate on a determined time in the future. Okay. The availability of forward contracts is growing, and hopefully it continues to grow as cross-border e-commerce continues to grow. There's a growing number of financial institutions that can cater to small businesses. This thing is growing. As e-commerce grows, this stuff is getting more and more available. So there's options in the market. Okay. So now let's return to the case. Let's see the case of our particular buyer. The forward exchange rate of pesos and dollars in 3 months' time is set at 19.57 pesos per dollar. So if he acquires a forward to buy pesos now, he will have to pay $1.941 million. Okay. There's no exchange risk involved. He just froze his exchange rate. Okay. Now let's see what he can get by using a money market hedge. Okay. The money market hedge involves the buyer taking a debt in some currency and making a deposit in another currency. Let me explain. So the buyer needs pesos, right? He knows exactly how much pesos he needs to pay his Jalisco exporter. Now, in this case, the interest rates he seeks are fixed. Okay, he's looking at fixed interest rates, which are here on the top of the slide. So he needs pesos. Okay, so in order to get 38 million pesos in 3 months, which he needs to pay his seller, our buyer must deposit 37.1 million pesos now in order for them to become 38 million pesos in 3 months. Okay. There's a fixed interest rate, so I know beforehand how much pesos I need to deposit now in order for them to become 38 million pesos at an interest rate of 9.25%. Okay. Now, assuming he doesn't have the money to deposit now, he must take a loan in his US bank in order to make that deposit in pesos. So the amount of dollars he needs to borrow is determined by the current exchange rate or the spot rate. Okay. And in this case, this would be equivalent to $1.90 million. So when his deposit in Mexico amounts to 38 million pesos in 3 months, he will use that to pay the seller. But now he owes $1.94 million in his US bank. Remember, he took a loan in his US bank in dollars. Now he owes a little bit more in 3 months' time. And this is the amount of in dollars for the actual transaction. Okay. Now, of course, a less complicated way to hedge is paying right away, converting the dollars if he has at the spot rate. Okay, he can use this leverage to actually make the transaction in 3 months' time. But if he has the money now, well, he can just pay at the spot rate and avoid exchange rate risks. Of course, that's also an option. Okay. Now, finally, let's see. Another way of hedging is using a call option to purchase pesos. Okay. Let's review. An option is a contract that gives you the right to purchase or sell a specific currency on a specified amount of time at a specified exchange rate and price. Okay, this only gives you the right, so not the obligation as the forward. Okay, to use that one. The forward is an obligation, it's a contract. The option is a contract for the right to actually buy or sell that currency. Okay. So the only thing our buyer will be forced to pay is the premium, which is the cost of getting that right. Okay. So the option has two prices: the exchange rate, the actual exchange rate, which is called the strike price, and it also has a premium, which is like the premium of an insurance. So this is the premium I will buy for having the option, and of course that's an obligation. If I want the option, I would need to pay the premium. Okay. Okay. Now options can be more difficult to access for small businesses, but hopefully, as in the case of forwards, the access continues to grow. I mean, there's a lot of innovation in this area, so hopefully it continues to grow. Let's return to the case. Let's look at our buyer again. Assume our buyer purchases a call option to buy pesos at an exchange rate of $0.05 per peso. This is called the strike price in 3 months. Okay, the cost of getting that right to purchase a pesos is $0.0099 per peso. Okay, now in 3 months' time, the buyer will evaluate if he exercises the option or not, or maybe automatically it doesn't exercise if the exchange rate is favorable for the buyer. Okay, so if the peso actually depreciates more than 0.05 per peso, as you can see here in the line, which is 20 pesos per dollar, he will choose not to exercise that option. Okay, so he has the option, he already bought the option, but he won't use it. He will go to the market to purchase his pesos at a lower price, of course, but he will still have to pay that premium. Okay, the premium, he already purchased the option, he bought it right, and he needs to pay the premium. Okay, so this graph shows what he will get exercising the option or not. Okay, if the peso strengthens below 20 pesos per dollar, he will exercise the option and would pay $1.937 million for the pesos, including the premium. However, if the peso depreciates, the buyer will not exercise the option and pay less than that amount. Okay, we can look at the next slide. So this is the summary of the scenarios that the buyer will be presented with. Okay, so the blue line is the unhedged scenario. As you can see, it's downward. It's a blue downward sloping line. So this is the range of all of the scenarios he can get. Okay, so if he doesn't hedge, he can pay as much as 2.20 something dollars per peso for the pesos he needs, or he can pay as less as $1.70 million. Okay, this is of course what he wants. Okay, so as you can see from these scenarios that go from 17 pesos to 20 pesos per dollar, all hedges will represent a gain or a loss avoidal, if you will. So he's going to hedge as from 17 to 20. You can see the rest of the other lines. In that case, he will actually get a benefit from hedging. Okay, if the peso depreciates beyond 20 pesos per dollar, okay, then the unhedged scenario was the best, followed by the call option, of course. The option gives you that flexibility to just purchase a premium, to go to the market to buy your pesos and just pay your premium, okay? But since we didn't know what would happen, hedging was probably still a good idea. I mean, let's see secondary effects. Let's not focus only on, okay, so hedging was probably best in this scenario, but we didn't know what would happen. So probably hedging was a good idea, okay? Now let's see the seller side. I'm going to be faster in these ones because we already talked about what the type of hedges were, and they're pretty similar for the seller side as well. Now, in this example, let's say it's a beef buyer in Brazil that has set his price in US dollars, okay? Now, remembers he wants reals, okay? Remembers he's going to, of course, everybody loves dollars, but he will need reals eventually to pay for the salaries of his workers, to go to the movies, anything that he needs to do with reals, of course. So he needs to convert those dollars to reals. So he wants to maximize the amount of reals he will get for a dollar, okay? And that depends on the exchange rate, okay? If the Brazilian real appreciates, he will get less reals. If the Brazilian real depreciates, he will get more reals. Okay, that's why we always speak about exporters are favored with a weakening currency. Okay, because they get more of their local currency if the price in dollars remain the same. Okay. Now, as in the case of the buyer, he can also purchase a forward, but in this case, not to buy the currency, but to sell the US dollars. Okay, there's also forwards to sell, make a money market hedge, or he can acquire a put option, that is to sell his US dollar when the time comes. Okay, this is a little bit different. The other one was a call option to buy pesos. Now it's a put option, which means he needs to sell his US dollars. Okay. Okay, so with the forward, as I said before, it's pretty straightforward. So the seller knows how much reals he will get. In this case, with this exchange rate of 5.39 reals per dollar, he will get 500 reals. Okay, 1,000 reals, of course. Now let's look at the money market hedge. So remember, this guy wants to get rid of the dollars once they come. Okay, so he sets up a debt in US dollar. Okay, he borrows an amount that will become $150,000 in 3 months' time, which is equivalent to 147,420. Remember, in this case, the interest rates must be fixed, so that way I can know beforehand what I will receive or what I will pay if I were a buyer. Okay, so he borrows that amount that will become $150,000 in 3 months' time. And how will he pay that debt? When the actual money comes from the buyer, he will pay that debt. Okay, but he can use that money now. Okay, so what does he do? What does he do with the money? He borrows in dollars. He converts it to Brazilian real right away. And if he could deposit that reals and earn interest for 3 months' time. So just to be ordered, so the money I actually will be getting in 3 months. So let's invest that Brazilian reals I just converted at the spot rate in 3 months' time, and that amount in reals equals to 807,404,000 reals. Okay, that way I hedge for any volatility in the exchange rates. Okay, so finally, let's look at the option, at the put option. Okay, so our seller can agree to sell the dollars he will receive at 5.30 reals per dollar in 3 months and pay a premium of 0.15 reals per dollar to do so. Okay, if he actually exercises the option, remember, he has the right, he can go to the market if he doesn't want to exercise the option. If he actually exercises the option, he would get 772,500 reals. Okay, but he might choose not to exercise the option and sell the dollars in the market if the real depreciates beyond 530 reals per dollar. Okay, if the real weakens, he would choose to go to the market. Okay, so let's look at the summary. You can see here first the blue line, the upward sloping line in blue is all of the scenarios that can happen if I don't hedge my currency. Now you can see the forward and money market hedges above, and that difference between those orange and red lines against the blue one are actually the potential losses I can avoid against the blue line, against the unhedged scenario, from 5 to 535 or 540, more or less. Okay, so if the real strengthens at this point, the hedge would make sense. Okay, so beyond 540, maybe the unhedged scenario was best, but as I told you, taking into account the potential losses, I mean, I tried to keep a fixed exchange rate, and I didn't want to worry about this volatility. Okay, so I lost a little bit of money hedging, but still, I think it might be a good idea to hedge. Okay, and finally, the put option would, in this particular case, would only make sense if the real depreciates beyond 550 or getting near to 560 reals per dollar. Okay, so hopefully those cases, those examples were helpful for you to understand some of the strategies that you can do to hedge your currency risk. Okay, so now let's talk a little bit about, okay, sorry, I just forgot to mention one thing. Okay, if you please go one slide before, Theo. Okay, if you see, you can see the forward and the money market hedge are pretty close together. I just wanted to explain this is because of something called interest rate parity. Okay, so the forwards will actually tend to be the price of the forwards is going to tend to be the same as the interest rate difference between countries. Okay, that's why you can see the lines pretty close together. Okay, just that parenthesis. Now let's move on. Okay, now I'm going to talk about current scenarios and a little bit of outlook. So I will start first with trade balances, since I didn't get to talk much about them last time. Okay, so as I mentioned earlier in the presentation, a trade deficit means that you're basically importing more than what you're exporting. Okay, that means your demand for foreign currency is growing faster than the demand for your own currency. So in that case, your currency depreciates. Okay, this is what has happened to a lot of countries this year. let's look at Japan and Korea, for example, which were experiencing trade surpluses before. Surplus is exporting more than you import, okay? And now let's look at how their currency depreciated as those trade surpluses started to shorten or as the trade deficits started to widen, okay? I want to speak about a particular example in commodities in Japan I just recently studied, okay? So Japan imports fresh beef from Europe, the US, Canada, and other countries, okay? Now, as the Japan yen has depreciated, it has imported less volume of fresh beef, okay? Because it has become more expensive, of course, to do so with a weaker yen. Now, remember, as an importer or buyer, if your currency depreciates, then it becomes more expensive to get products elsewhere, okay? But if you actually look at the trade flows among regions, you can see that for some reason, imports from Europe have actually grown. Japanese imports from Europe have grown, okay? While imports from the US and Canada decreased in percentage terms. So, of course, there are a lot of effects and variables involved. It's pretty difficult to just point that to a particular thing that's happening. But it's worth noting that the Japanese yen has depreciated much less against the euro, just 4% year over year, than it has against the US dollar or Canadian dollar. So there might be an effect of the lower currency depreciation against the euro that has actually led to a changing of trade flows in this case for this product in Japan. Okay, let's move on. So now let's look at the other side of the coin, the US. The US has mostly traded deficits in the last decades. It's almost always in deficit because it has a large demand for foreign products, okay? But if we look into 2022 monthly data, we can see how it has started to narrow, that this deficit started to narrow after a very big widening in March. And this also corresponds to a strengthening US dollar. You can see here in the graph, as the deficit narrowed after March, you can see there's a clear upward sloping dollar there, okay? Okay, now if we go to Europe, we can see that as in the cases of Korea and Japan, the euro has depreciated with a widening trade deficit, okay? Now let's look at another country, which is Mexico. So the Mexican peso has been one of the few currencies that has actually remained stable or even strengthened against the US dollar this year. And you can see its trade balance is more mixed. It has tended to a trade deficit as well, but it has experienced more surplus for some months, deficits in some months. So the picture is more mixed, and you can see that may be reflected on a more stable peso, not a clear weakening trend in the Mexican peso. Okay, sorry. Now let's look at a wider set of currencies, all set against first the US dollar, okay? So as you can see in the third column, year to date, only the Russian ruble, the Brazilian real, and the Mexican peso have appreciated against the US dollar, okay? Most other currencies have depreciated. The good news for importers in those countries is that the US dollar has mostly weakened so far in November, okay? But it's too soon to call for a trend reversal. So you can see here in the fourth column here that November has actually seen most currencies appreciate against the US dollar, okay? But but actually, most analysts are still expecting further depreciation of most currencies against the US dollar, okay? But as I have said before, please take this with a grain of salt. Exchange rates are notoriously difficult to forecast, okay? As there are many variables at play, okay? So this is just what most analysts are saying. They were expecting depreciation, but of course, anything can happen. There are a lot of variables involved, okay? So now let me talk how, if actually a more depreciation of the local currency happens, this of course favors the sellers of those products, the exporters, as they get more local currency for the dollars, okay? It also favors the foreign buyers, which now can purchase more of the local products with the dollars, okay? And of course, this also reflects on the margins. Let's say maybe I have a competitor elsewhere that has a strengthening currency, so my weaker currency can allow me to actually lower prices in dollars and keep my margins because the currency is also depreciated, Okay, so I'm getting the same amount in local currency than before. That gives me also margin to actually lower my prices. Okay. Now, finally, let's look at the cross rates with the euro. Here's some of the scenarios you can see. Now, most currencies have actually depreciated this month against the euro. And the picture looks much more mixed. So you can see here the ruble is expected to depreciate against the euro. The Mexican peso is actually to remain stable. So you can see there's a mixed bag of expectations here. But again, please take these expectations with a grain of salt. It's always good to be informed, to know what you can do. And hopefully this was helpful for you. This information we provided is helpful to you. You can look at Tridge, of course, to always be informed for this. And I thank you a lot for being here and for experiencing this webinar. Thank you.
Thank you very much, Rene. And yeah, the three ways that you showed in which we can hedge our currency against currency fluctuations, I think that's really useful. So we're gonna go to the more, let's say, the more practical parts of how we can implement these strategies in a practical way, which will be done in the panel discussion. Now, I just want to mention that because of the nature, like I said, it's a bit of a complex topic. So the slides will be available, so you can take a look at Rene's examples once again. So we will be sending these slides out. Now, for the panel discussion, we're going to take some questions that we received beforehand from some of our viewers. And then I also want to open up the chat. So if you have any specific questions you want to ask our panelists or to Rene, our presenter, or questions in general, you can put them in the chat. We'll try to get to them today. We have quite a jam-packed session, so we'll see if we can make it, but please put them in the chat. If we can't cover them in this webinar, we will get back to them and we will send the answers when we send out the slides. So please make use of that option. So excited to talk to our panelists today. I'm going to ask them to introduce themselves and then also just tell us a little bit about your role in Tridge. So I'm going to start with Ahmed and then Ron and then first. So Ahmed, can you please take it away?
Hello, everyone. It's very nice to meet all of you virtually. So first of all, let me introduce myself. My name is Ahmad. I'm a Global Fulfillment Manager for Tridge in Egypt. I mainly handle the exports of citrus and grapes and pomegranates. So that's what I do. And hopefully I can start now with giving you a little brief about the Egyptian environment that touches this case, because we have faced a lot of issues with the currency valuation in the last few years. So just to give you a little background, I'll be focusing mainly on how the changes in the currency actually affects the cost structure of the products, because I think to understand or to have a forecast or how to deal with the value of the currency, you need to understand how the cost structure of the products work. Because if you do understand that, you will be able to make better decisions. So I will mainly speak about what Egypt went through in the last few years. So just to give you a little brief, we can start at 2016. 2016, after our revolution, the US dollar against the Egyptian pound was, the one Egyptian pound was around $8.3. That was 2016. After that, we had a series of currency depreciation. In 2016, it went from 8.3 to 18.8. So that means the Egyptian currency lost around 127% of its value. Then again, in 2022, we went from around 15.6. I mean, one US dollar is equal 15.6 Egyptian pounds. Now it's around 24.5. So just to summarize, not to get lost in numbers, from 2016 until today, the Egyptian pound depreciated by around 200%. So that's a huge amount of depreciation that we had over the past few years. So I would just, of course, I'm not gonna go and cover what we have been covering before, but I just wanna let you know how this affects the cost structure, because I have found out that a lot of buyers, a lot of importers from Europe or Asia or other countries, they think that once there is a value devaluation, the prices will go down. And then they are disappointed to find out it doesn't go down. Because here comes, we have to understand the cost structure. Egypt mostly imports fresh foods and vegetables. That's our main imports. But on the other side, we need to see how is the cost structure of these products. First of all, before we get to the final product that we export, we have the raw material cost, which by the raw material, I mean the boxes or the paper bags or whatever we pack in. We have fertilizers and pesticides and things like that. We have electricity and other utilities, and we have labor cost. We have a lot of costs, but just the main factor here is that we import a lot of these things. To make the carton boxes that we use to pack, we import the raw material from outside of Egypt. So that means when the dollar goes up against the Egyptian pound, that means the prices will go up. Second thing is the fertilizers and the pesticides. We import these from other countries. So that means also the cost goes up. The last things that respond to the devaluation of the currency, unfortunately, are two things: the labor cost or the salaries. They are the latest thing to get affected, because it takes a lot of time for the salaries to reflect the actual currency value. On the other hand, the cost of farming as well, it gets, because it takes it takes a long time to harvest. So that means it gets affected later than all the other factors. So just to make this short, I just want to say in the end, for example, let's compare the prices last season with this season. We will see that although that the US dollar compared to last season rose by around 57%, we find out that the final prices this season are almost at the same level. Why? Because in the end, the devaluation of the currency was balanced out by the high cost of dollars. So in the end, actually what happened in Egypt is that we did not have much change in the prices. This is not the ideal case. This will not happen every time, but this time it happened just like that. So in the end, I'm not gonna get through again how to like lower this risk of the currency devaluation. I just wanted to explain how the cost structure for these products work, so that if someone is here is doing business with Egypt, so that they can understand how the cost structure works, and hopefully make them have better understanding of what the outcome if the currency depreciates or appreciates. So I don't want to take any more time than that to give the other panelists more time. So please let me know if you have other questions. Thank you.
Thank you very much, Ahmed, and thank you for that. The background and the situation, like we mentioned, the countries that we try to cover has been influenced a lot by currency fluctuations. So thank you for the background. We're going to go to Ron. Ron, can you also give us a brief introduction, and also just tell us what involves being a global fulfillment manager in Tridge?
Yeah, thank you so much, Theo. And hello, everyone. Welcome. My name is Ron Sahu. I am a global manager from India, and I've been working here since more than half a year. and it has been a wonderful journey with Tridge right now. And I take care of the categories seafoods, fruits, and vegetables as well. So, on the sense, if you say agri products, I take care of entirely over here, even into imports and exports. Both the things I take care of it. Moreover, I want to put on focus on the depreciation value of INR towards the USD. What we have been seeing is moreover like imports have been very less right now, and exports has been boom. I guess not into figures, but it has been more than 150+% we have been exporting right now, and imports of fruits has been mainly in India right now. Nothing more into it. So I'll add on, moreover, whenever we have any of the questions, I'll pass on to the next panelist, Mr. Per. You can take it. Thank you.
Yeah, good afternoon, everybody. Good morning for some of you. My name is Fernando Dupuis. I'm Chilean. I'm based in Belgium. I'm global distribution manager, and I'm basically in charge of import or bringing goods to our distribution center based in the Netherlands. So from which we are going to deliver, that's what I'm going to do is delivering these products, for example, from Ahmad oranges to our clients and all across Europe. So that's my role at Tridge. I'm almost 1 year here, yeah, a little bit more than 11 months. So pretty happy. And I want to focus mostly on how importers and exporters are trying to protect themselves against the currency fluctuations of the money, actually. How can they face, for example, evaluation of euros this year was pretty challenging for all European importers and at the same time for the South American exporters. That's it.
Thank you very much, Ron. And we're going to go, well, I guess this is the most important question today, which is how do you practically, if you're an importer or an exporter, how do you hedge against currency fluctuations? So I'm going to ask all three panelists to answer that. We're going to start with you, Ron. So Ron, after you've given your answer, you can just give over to Fur, and then Fur, you can give over to Ahmed, please. So Ron, over to you.
Yeah. Thank you, Theo. Well, that's a nice question. Well, a very smart importer chooses to hedge in order to react quickly to the currency swings we have. So it is essentially a cautious action designed to protect you from experiencing the worry of probability of losses, what Rene explained. So in businesses, whether it's an importer or exporter, they always want to achieve profit in the mind. So this method is superior to the conventional ones, what usually like freezing of previously agreed upon the pricing. So there is less concern of financial losses. So this approach will be important in preserving the company bottom line and properly understood and applied. So this particular form of hybrid security, like what we explained in the presentations as well, you can say like there's a summary of that. So like we have forward contracts, forward agreements to buy and sell any of the assets. We have predetermined prices and dates. So these forwards are agreements between two parties that define the sum, timing, and the terms, what we design for a particular period. So as a result, you'll be able to get your money through this particular period. So this is where the hedging takes care. Thank you.
My turn, right?
Sorry, yeah, over to you.
Yeah. So well, on the importer side, it's also important to know what is on the exporter side. So as Rene mentioned, one of the most interesting tools or the more popular tools in South America is the forward contract. So for example, we use the Chilean case of grapes. So at this moment, the Chilean peso is costing is 900 Chilean pesos for $1. So this particular exporter is going to the bank, and they're going to fix exchange rates, for example, 915 Chilean pesos per dollar. So the transaction is secure at that level. What happens if for example, the Chilean peso is costing less? Let's say it's getting stronger. It's 800 Chilean pesos per $1. Then the exporter has to pay back to the difference to the bank. But on the other hand, if the Chilean peso is depreciated, then getting into 1,000, for example, Chilean pesos per dollar, he has to pay the difference to the bank. Sorry. In the previous example, if it's going to X800, the bank has to pay to the grower and to protect them. But if the grower is getting a benefit of a better or the highest depreciation of the Chilean peso, then they have to pay to the bank. Now, what they're looking for is for a long-term relationship and sign next season another forward contract. So sometimes the bank also said, okay, now we're going to close it instead of 950, we're going to close it at 950. Okay, so you don't have to pay me 85 Chilean pesos, but only the difference. Okay, so that's one of the tools that are using in Chile, and it's very popular. And unfortunately, for many exporters based in Peru, Chile, etc., they didn't forecast the situation that happened in Europe. So they were losing money because the Europeans were not able to commit to minimum guarantees agreed, just because the euro versus the dollar depreciated 15%. So although they find the way to pay back somehow the minimum guarantee, it means that many companies in Europe are close to how can I say it? It's not very pessimistic, but to bankruptcy. That's a very important issue. So how are doing the importers to protect themselves? They're doing three alternatives they have. So either they buy a large amount of the most current currency, the most current currency they're using to make the overseas purchase, in this case, US dollars, for example, or what is very popular among the very big or large importers. I'm not going to name it, but some of them are owners of shipping lines or vessels. They fix an exchange rate with their suppliers. Say, okay, this is our exchange rate for the whole season, take it or leave it. That's one. And the last one, and that is getting very commented and maybe will be popular next year, will be something called exchange rate insurance, which is a commitment by means in which the client and the bank is with the bank are mutually obliged to exchange an amount of foreign currency at a fixed price at a future date. So that's are the ways that they're trying to protect themselves on both sides of the cycle. That's it.
Thank you, Fer. And then also, Ahmed, can you tell us the best way it's done in Egypt?
Sorry, I didn't realize I was muted. So, okay. To be honest, to answer this question about Egypt, it's going to be very difficult because unfortunately, Egypt is one of the most unpredictable markets that you can ever see. Also, it's very like it's not like I mean, there is some chaos in these decisions like that. Actually, the safest way to deal with this topic with the Egyptian, if you are an importer outside of Egypt, you need to actually predict when the currency is gonna depreciate, because 3 months from now we knew that we will have another depreciation of the currency. We're just waiting when it's gonna happen. So just to make this short, for Egypt, it's very hard to deal with this and very hard to predict. And if you are an importer, on the other hand, an Egyptian importer, what we do these days is that you try to get as much stock as possible, because nothing is going to protect you. Unfortunately, I cannot tell you what to do to deal with this in Egypt, because we have had 3 times of major currency depreciations, and every time it was different. Whatever you do, you cannot expect. And I'm really sorry that my answer is that vague, but really the Egyptian market is very unpredictable.
Thank you, Ahmed. Yeah, I mean, there are some different tools available, but it's difficult choosing the right one, and also, the situation might be different in every country. We're going to go to the next question. I just want to mention we might go about 5 minutes over the time of the webinar, just because of the nature of the topic we're covering, which is quite complex. But we're going to continue to the next question. So the next one says, when you're negotiating with clients, what are the major strategies that you should get in place? So how to reduce the risk trading before negotiating with clients, and what are the strategies for agricultural trade? So let's start with Fur and then go to Ahmed and then go to Ron.
Yeah, I will try to make it very short and precise. So when you said how to reduce commercial risk, it's based mostly on the relationship that each other has with their clients. So the KYC, know your customer. The history is the basics. So for new clients, you will always ask for big advances, maybe prepayments, and then the second part against documents. So you're 100% covered, or at least 80% covered, and you're sure that the transaction is going to be made in a safe way for the people who is going to provide the service or the goods to a new client. However, when the relationship is getting larger, bigger, and more interesting, and there's a big exchange that you go through 1 or 2 seasons together on a certain product, then you are going to look for more flexibility. And also, the key is what an exporter mentioned to me of cherries from Chile. He said, now the most important for us is to ensure a profitable business for both parties, which means low margins, I mean margins that make you live, actually. Okay, so you pay your materials, all your expenses. You make a profit also for the owners of the company, but you don't have to think about 20-30% of margin, because that's it's not going to work for nobody. So they're looking at the same time for in that respect for low margins for importers that are thinking on the same page. For example, which has contact with retailers. Contact with retailers are not super, because they're not high or super expensive, but at least that gives you the security of a certain money, a certain price fixed for the season. So that's what it said when, so we are going to reduce our margin on this side, but the importer also. So it should be a win-win situation. And as mentioned, and the importer side, how they protect on they reduce the risk during the trading is the opposite way than the exporter. They try to pay less and get better payment terms, So instead of paying 80% advance, they will always aim for 30 to 50% maximum, and the balance are paid 30, 45, or 60 days. So that's why it's a constant battle, let's say, but it's part of the game. And yeah, but everybody at the end of the day, as that exporter of cherries mentioned, we need to find a way and the right balance in order to make this work for everybody. That's it. Next.
Thanks. Over to you, Ahmed. I think you're muted again. So
No, actually, what I found useful this season, if you are a buyer and you're planning to buy any agricultural product from Egypt in times like this, it will be very useful if you can give your suppliers more leverage. For example, if you have like a long-term contract with for a certain product, the best thing to do is to give these suppliers, of course, if you trust them, if you have a history with them, give them a good prepayment before the season starts. In that case, whatever happens in the season, they always put you as a priority in pricing and everything, because you help them secure the raw material that they need, or the other other costs before they have any risk of currency devaluation, if that makes sense. So if you give these suppliers some leverage from the beginning and you make them a prepayment, they will be able to secure your product at a lower price than the prices in the future when the currency depreciates. And in the Egyptian case, we knew 100% that it's gonna depreciate. So we made these decisions very early. I hope that makes sense to anyone.
Yeah, I'll just add on over here. Thank you, Ahmed. As we are short of time, I'll just finish up. So both of the panelists have most overtaken all of the things. But main thing what we want to understand is like the market evaluation. We need to have it like current ongoing price and the quality what is going on in the local market. You also have to compare the data between weeks and week and last season, last year price point data. And even moreover, if you see the crisis, what is going on. So these are the external factors like risk of inflation, political risk, if there is a decreased market demand or what. Even you have to go to a consumer and you have to check out the consumer preferences in the export market in the different particular countries. And moreover, I think so like if you are an exporter, then your export promotion through different webinars and exhibitions are there. And just to add on over here, Exhibition 365 by Tridge is also one of them. So you can also have it. Yeah, that's it.
Right. Thank you very much to our panelists for your answers. We're going to cover one more question. I just want to mention that if we're going a little bit over time, but the webinar will be posted on our website and will also be up on media platforms. So if you need to leave, that's totally understandable. But we're going to go about 5 minutes over time because I think this is quite an important question also. So the question is, in a situation where you're taking on debt in a foreign currency, how can you kind of manage the risks involved? So the question is there a way to mitigate debt-related risk on agricultural products in countries managing hyperinflation and the devaluation of the local currency? So this time, let's start again with you, Ahmed, and then we'll go to Fur and Ron.
Okay, let me answer this question from the point of view of the exporters, because that's my main focus. For exporters, first of all, they do two things. First of all, they never have debt in the foreign currency. They always want to keep their debts in the local currency because they always under the fear that the local currency will depreciate. On the other hand, to cover themselves, we always do our contract with other countries in US dollars. So in that case, when the currency devaluates, the difference in the exchange rate will cover their losses that came because of the hyperinflation. So that's a very basic standard thing to do here in Egypt. You never take debts in any foreign currency. Keep it at local currency because your income is going to be in the foreign currency and it's going to cover your losses. So that's the key point that the suppliers here do. I hope that answers the question.
Yeah, so more or less this is a question that is wrapping up everything that we were saying. So for an exporter point of view, they said this cherry exporter said that there's not much that they can do except for two things. Which one? Or you take a bank instrument such as a forward or the exchange rate insurance, or you deal with your client, and especially when you have a long-term relationship. So that's the way they're handling this from exporter point of view. From importer point of view, the big ones are already putting, as mentioned, a fixed rate for the whole season. So if you want to work with them, you can take it or leave it. That's one. They're massive, so they don't mind. They have plenty of growers. And on the other hand, again, the importers are tending to buy on a spot basis the dollars in order to pay to overseas currency. I mean, for example, to Peru, to Mexico, to Chile, to Argentina, they have to pay in dollars. So they are buying at the bank on that currency. That currency. Or some of them are thinking, as I mentioned, exchange rate insurance. And finally, the final decision on the import side is, if you see that all the costs at the origin are multiplying and increasing, and you're not able to translate those to the final client, then don't bring it. That's my opinion.
Thank you, Fernando. I just want to quickly add it over here is like here in India, people are basically maintaining the records, how much it is depreciating. So by evaluating the balance sheets, income statements, then a particular exporter can adequately evaluate their financial performance based on this. And based on that, they can calculate their current debt to asset ratio. and they can make a better decision based on secured loans at a lower interest rate from the banks. And even by managing the marketing and production risk also. So they can basically calculate the expenses and the revenue from a particular farmer. And based on that, they can recalculate how they can reduce their loss due to this production loss or basically the fluctuations in prices. And some other ways, what we can't way of out is also like smart loans or off-farm employment if nothing can be done, and renting, leasing their existing areas. So that all basically here in India people are doing. That's it. Thank you so much.
Thank you so much to our panelists for answering these questions. I hope it will help all of our viewers also make an informed decision when it comes to hedging against the risks involved with currency fluctuations. Once again, also thanks to Rene, our presenter. One quick last message that Tridge is opening our banner service, so for banner ads. So if you want to get your message across on our platform, you can use the service, contact our sales team or contact somebody at Tridge. And, you know, Tridge has more than 500,000 active users on our platform. So it is a good way to get your message across. Then just on a final note, from our side, we really enjoy these webinars and we think it's a good way to keep everybody informed. But if you have any questions or comments, please contact us, intelligence@tridge.com, or just visit our website. So once again, the recordings and the slides will be sent out to everybody. And thanks a lot for everybody who joined us today. And a special thanks to Rene and Ron, Ahmed and Fur, our panelists. So thanks once again for everybody, and enjoy the rest of your day wherever you might be.